Hello guys, it's CastAwayTrader and welcome back to my YouTube channel. It's been a long summer and it's time to post a new update because yesterday I posted a very bearish long-term forecast for S&P 500 and I called that video "Dark Days Are Ahead of Us." But before we start, I want you to read that important disclaimer. I am not a registered financial advisor. Past results are not indicative of future profits. Thank you. That is the chart I posted yesterday in my Twitter account, CastAwayTrader.com. And if you have not followed me on Twitter, please do that. And I will leave a link to my Twitter account in the description of that video. So what you see on that chart? You can see that we got a strong rally of the low made in March 2020, so-called the pandemic low of that strong drop. This is, by the way, the weekly chart of S&P 500 index. And of that low, we made a rally structured as ABC, and I believe that ABC up was the final wave 5 up that completed a large rally that started in March 2009. So we are talking now about a completion of that large rally that lasted more than 12 years, and you should expect the market to produce a large corrective structure that would be comparable in size to that rally. And what we are seeing now, just the beginning of that move. And I teach my students in video courses I offer is that the wave forward, so when a rally completes the 5-wave up structure, the very first target and simultaneously the most important support is the low made by the preceding pullback in wave 4 of 1 degree lower, and that low was made by wave 4 in March 2020 around 2191, and most likely the very first important low would be made by S&P 500 around that level. It could stop a little bit higher than that, around 2547, and I'll explain in that video how I got that number. Or it would be preferably, it could violate that law to run long-term stops and overshoot that law to take, for example, 2070, only to bounce back over that level and produce a corrective ABC up structure to another lower high. So many of you have questions when we should see a new higher high over the top made in January 2022, and my simple answer is that you will not see it soon enough. It may take several years at least until we get the low, a big low, major low of a corrective structure. But at the very least, I would expect the market to produce another large move down, the second leg down, and I will explain why I call it leg down in that video, and to find support somewhere in between 2500 and 2000. And you may notice that I use very strange labeling of the waves that looks different from what you normally see posted by other Elliotticians. It's not that I made mistakes, but I use a better version of the Elliott wave theory, a modified version which was proposed by Ian Copsey, a very famous veteran trader of FX currencies. And if you want to read more about that modified version of the Elliott wave theory, you can go and read my free blog post posted on medium.com, CastAwayTrader. This is the address, and again I'll post that address in the description of that video. And there you will see a plenty of articles explaining in detail the difference between the classic Elliott wave theory and that modified version, and you will see how you can easily use that theory to convert wave counts into trading setups, which is what 95% of Elliottians would not share with you. They would only share with you is a wave count, and they would kind of imply silently that you really understand what you are going to do with them, what you're supposed to do with them. But it's not that easy. Those are very two different topics: how to count waves and how to trade based on waves. And in that video I'll show you a link and special offer for my video course, professional video course, that teaches you exactly to do that. Let's move on. The foundation of that forecast is that ABC corrective structure, a fractal, a repeating pattern that can be found on any chart, including cryptos, including forex, including bonds, including any asset you can get a chart of. And that structure shows you that every rally would be followed by a corrective pullback, and that corrective pullback would be structured as three waves. So it has three segments, we call them waves: A down, B up, and C down. And what's really interesting about that fractal is that wave A down is itself structured as ABC, and wave B up is structured as ABC, and only the second leg down in wave C is normally structured as 5 waves. And this is why many professional traders would focus their trading activities on the second leg down, because it's stronger, it takes more time, and it's much better predictable because it has 5 waves, and we could use a bunch of different tools like Fibonacci extensions to actually forecast potential turning points up and down. And I'm going to show you how you can do it in my video course and even in that video. So now I invite you to journey to the past, to 2008, and I would ask Marty McFly and Doug Brown from Back to the Future movie to help us to make the trip to 2008. So this is what we got in 2008, and that is an epic decline we got in S&P 500, it's actually AS mini futures, over the top made in October 2007, into the low made in March 2009. And look at that, we got the very same ABC fractal. I show you that chart to convince you that that fractal actually exists, and you can find it in on any time frame. But that specific fractal is very interesting for us because it shows very similar, and based on that specific fractal I made that very bearish forecast. Look what we got. We got first leg down A, then pullback in wave B that retraced 50% of the preceding decline, and it was also structured as ABC. And the second very powerful move down that was structured as 5 waves. There is a rule: in any corrective ABC structure, the second leg down, wave C, relates to specific ratios to the distance traveled by the first leg down in wave A. And in many cases we would get the second leg down to bottom either at 123.6% extension of the first leg down wave A, 138.2%, 176.4%, or in the very extreme cases, like it was in 2008, 223.6% extension of the first leg. What that means? Very simple. You just measure the distance traveled by that move in wave A down, and you project it from the top of a corrective pullback in wave B, and you get your targets. The second leg down in any ABC corrective structure is subdivided into 5 waves, as I mentioned, and therefore they start from a bearish one down to up setup. Let's come back. You can see before the acceleration down starts, we got relatively small move down in wave 1, followed by a weak pullback in wave 2. And that's a very important thing to know about the way how the price moves in the stock market. Even if you nail the top of a corrective pullback, you would not normally get a very strong move down in the direction you expect. You would get some small moves. So look, that was the major top, and we started to get small moves down that did not look like start of a huge decline. And then was another pullback and a bigger move down. You see, like every new move down would get bigger and bigger. That one was bigger than that one was bigger than previous one. And only when the final move down in wave 5 is smaller than the preceding, the strongest one, wave 3, that would be the sign that bears are getting exhausted, and that would be the sign that probably it's time to think about longs, but it's too far away from us. Let's come back to reality. So what I want you to see, to note about that wave 1 we got in July 2008, is that it actually managed to undercut the previous double bottom made by the first leg down or by wave A. Now let's get back into the time machine and jump back again to the current time and see what we have now. So this is what we have now, again the very same weekly chart of S&P 500. This is our first leg down, and then that corrective ABC structure managed to make a lower low. So what I would expect is that wave 1 down of that new 5-wave down decline would violate that law, and that would scare retail investors. And if we come back to September 2020, look at the top made at 3,588. I think that top would most likely turn into important support for the first move down. Not only that, look at that pinkish line. This is 200-day moving average. So everybody watches 200-day moving average on a daily chart. I would watch it not on a daily chart, but on any time frame, from 15-minute chart to a weekly chart. And look at that weekly chart and look where it is located now. It is located now at 3,560. But it's still climbing. It has an upward slope. So basically, technically speaking, until we break under that line and we retest that line from below, and bulls fail to reclaim that line, we are still technically in a long-term bullish trend. So, you know, if you really want confirmation, if you're a long-term trader or investor, so until that moment, you can feel safe. So when you should start worrying is that when we break under that line and bulls fail to reclaim that line. If you are shorter term traders like me and majority of other traders, you have enough evidence that the market has stopped. And that is your evidence. That is blue line, 8 exponential moving average on a weekly time frame. So look, on the way up, when the market was trending up, that moving average actually caught several important pullbacks, like here, here, here and there, until it stopped doing that. Look what happened early this year in January, February. Price broke under that support and tried to reclaim it but failed. Look at those long tails. Bulls failed to reclaim that support, that turned resistance, and we got 5 weeks of decline non-stop. Then another attempt. Bulls felt like, you know, they managed to reclaim it, but then we got that weekly doji at the top, and that was a corrective wave B up. And then another bearish attack, and we immediately sliced under that support. And look, we got another 1, 2, 3, 4, 5, 6 uninterrupted weeks of decline, and that 8 EMA weekly was pointing down. So it turned into an important resistance. So the same failure we just got last week. Bulls managed to push over that line, we got that weekly doji, and the last week was epic drop and we closed under that line. So once we close under that line, normally we get a good bearish follow through. So the most obvious target for that move down is around 3,550. Now let's come back again to that chart from 2008 and let's look what actually happened after we got that first leg down in small wave 1. We got a corrective wave 2. This is what Elliotticians call a golden goose, 1 down 2 up setup, a bearish short-term setup that would let you build a short in anticipation of the strongest accelerated part of the move down in wave 3. In any 5 wave down, wave 3 is the strongest one, and 1 down 2 up setup is the most attractive shorting setup you could possibly get. But we use so-called retracement tool. What we do is that we measure the decline and we add specific retracement ratios, and I teach those most common ratios in my video courses, and those ratios differ from everything else other people would tell you on the internet. For example, my favorite one is 41.4%. That ratio was found by Ian Copsey, and nobody else uses that ratio, and that ratio works like Swiss watch. And this is exactly where in September 2008 that pullback stopped at 41.4 retracement. So if we add 41.4 retracement and the classic 50% retracement, that tells us that once we get that first move down and we breaks under the low made in June-July, we may get another pullback into the year end this year, up to 3,900, up to 4,000. And that would be the very last chance for bulls to close their long positions and for shorts to load on shorts. Now let's come back to the 2008, because see, the most interesting question is that, like, if we expect such a strong drop in wave 3, the strongest part of the decline, right? So what is the target, you would ask me? And in any corrective ABC structure, we use extensions. It's a Fibonacci extension tool. It works pretty simple. We just measure the first move down in wave A and we project it from the top of wave B. And there are 4 repeating ratios, and I have already shown them to you, and we can see that in 2008, so the market dropped fast to 176.4% extension of wave A, and that could have been the bottom. Look, we got 2 very strong pullbacks, A, B, C. So we got another corrective ABC up, and it's so-called a flat corrective structure because the second leg up was not stronger than the first leg up. And because bulls failed to start a new rally, bears stepped in again and we pushed down again, ABC down to a new low. And that was probably around 200% extension, not a very common and very reliable extension. So the next one, the strongest extension fib we have in our toolbox, is 223.6% extension. What that means essentially is that that move down would mean that the second leg down was 2.2 times bigger than the first leg down. And this is exactly where the drop early 2009 stopped. It did not, nail it up to the penny, but close enough to call it the win. And this is what we have now in 2022, 2023. So my calculations show that wave 3 could go as deep as 2830 or even 2550. And look, those 2 arrows show those 2 important extensions, 176.4 of the wave A and 223.6 of wave A. In a similar way we have just discussed that happened in 2008-2009. So we would have to watch carefully what reaction, bullish reaction, we get from the 25.50 level. It's very possible that the whole move down would stop here. But as I mentioned, again, we should keep in the back of our mind that very important strategic level 2190, that is the pandemic low, that is the magnet. The low made by wave 4 or 1 degree lower, the low made by the previous pullback is the magnet for the first large ABC move down. This is why it's very possible that that whole 5-wave down structure would find support slightly under 2200. And slightly, if you take into consideration the scale of the moves we are talking now, it could be 2070, exactly 223.6% extension. And you should understand that once we get that 1-2 structure, we would add extensions to that structure and we would be able to come up with much more accurate forecast in connection to where we can expect the bottom of wave 3, the strongest part of the decline, and where wave 5 could find that support. We can actually apply the very same principle of extensions to extension of time. Let me show you one trick. So this is my TradeStation charting platform, and this is that pattern of the decline. So if we measure the period of time spent by ES Mini on the decline from the top in October 2007 into March 2008, kind of the first leg down, and we add 223.6% extension, look where the 223.6% time extension is. So it almost nailed the very bottom of that move down. That's incredible in my opinion. Not only that, let's measure wave A in terms of time and let's see how it worked. So if we measure it from the top of wave 2, look, it nailed the bottom of wave 3 and it nailed the bottom of wave 5. So if you have doubts, if you had doubts that those time and price extensions really worked, now I show you evidence that they really do work, and it really makes sense for you to learn about them. Now you could say, okay, what we are going to do, so the market is going to move down until September, October 2023. So if we apply the 223.6 time extension in the way I've just shown you worked out well in 2008, and we apply it in the same way to the chart of ES Mini from 2022, so that would tell us that the whole move down could find support somewhere in autumn 2023. And you could say, like, okay, is trading done for the next 12 months? And my answer would be no. No, we have a great opportunity to make good money trading the downtrend, and where will be plenty of bear rallies. And one of those bear rallies we just completed last week. And you may still remember how strong was the rally. And those bear market rallies, they are very strong. But to successfully navigate through those wild pullbacks and make money on them, I would strongly recommend you to learn about that ABC corrective structure, because it's the most reliable tool in my toolbox. And this is why I suggest you to enroll in one of my video courses. And in that video, I'll give you a special, very low price for that. And if you don't like results, if you don't like my lessons, you just have 30-day money-back guarantee. But this is the most common way how pullbacks behave. Look, we got ABC up. the black segment of that chart. And I am going to show you that we actually had several of them this year. Here ABC up, here ABC up, another ABC up here, another ABC up here, another ABC up here, and all those 6 big rallies we had in that overall bearish year. You could have traded really well and you could have made money if you understood well how that fractal works. So let's zoom in. You see the same fractal, 2 of them in April and May 22. ABC up. Another one in May, ABC up. Another one in February, March, ABC up. Another one in January, February, ABC up. Even here one, ABC up. And all of them followed the very same fractal with slight modifications, with slight variations, and I explain them in details in my video course. So in general, every strong move down making a lower low would be followed by a corrective ABC pullback making a lower high, confirming the downtrend, followed by another strong move down to a lower low. This is my video course, professional video course, and normally I charge $79.99 for a lifetime access. But Labor Day is coming. You know, people love Labor Day sale offers, and this is my offer. Instead of $79.99, you can pay only $49.99 for a lifetime access. And that offer is valid until 9 a.m. Eastern Time, September 2nd. And in that video course, I will explain in detail how each of those fractals worked out, those pullbacks worked out, and I will compare them to the fractal, and you will see that they closely followed the fractal. And if you want to have even a better learning curve, I would strongly recommend you to subscribe to one of my plans. I host a trading chat room on Discord platform, and in that chat room I post numerous updates on a micro scale, on a macro scale. My preferred time frame is 15-minute chart, so if you are a day trader, I would share with you a plenty of attractive setups, trading setups. So the most economical one, the cheapest one, is $149.99 for 3 months. It's a quarterly access. So you pay once and you have access to my updates on ES Mini and S&P for the following 3 months. But frankly, I would recommend you to step up to that plan, because that plan, it's also a quarterly plan. It covers not only ES Mini but NQ Mini and RTY Mini. And this is why you need them. Even if you trade only ES Mini, I would strongly recommend you to follow NQ Mini and RTI Mini as well, because in majority of cases, those two instruments would offer you better wave counts, cleaner picture, and more reliable forecast than ES Mini does. Probably because ES Mini is so impacted and manipulated by big funds and algos. Maybe in some way NQ Mini and RTI Mini are not that impacted and manipulated by them. I don't know why. If you want to a bigger, like a better coverage, including gold, silver, crude oil, natural gas, if you want to ask me specific questions and if you want some counts per request, this is your preference. This is a full coverage, full all-inclusive plan. And if you want to save on that plan, you switch to a quarterly plan, and on the quarterly plan you have the full coverage and you save 23%. And each of those plans offer you 15-day trial, and if you don't like them, you just cancel it and you will not be charged again. And a special Labor Day bonus. You may know that in addition to counting waves, I've been developing a suite of proprietary indicators for TradingView, and I believe I created really powerful toolbox of instruments for cycle analysis. And for example, those two charts show you last Friday, and you can see that both of them caught the last move up. We got strong buy signal, and once price turned down, those indicators printed sell long signals, and that was the start of the huge drop down. And normally I charge $49.99 for access to those instruments, but if you subscribe to one of those plans on CastAwayTrader.com until the end of the Labor Day weekend, that's September 4th, you will get complimentary access to proprietary indicators in TradingView for the period of your subscription, active subscription with CastAwayTrader.com. That offer is valid for new subscribers only, and it's valid only until the end of the day, September 4th. In addition to that, you will get access, complimentary access to a trading chart with live signals, and you will see that the bot posted a topping signal at 9:40 a.m. in the morning, just 10 minutes after we opened on Friday, and it confirmed that it detected multiple cycles that topped for QQQ, for SMH, for IWM at 9:40, and that was a very close to the exact top of the day and the exact top of the August, I guess. So this offer is valid for new members only. I said until the end of the day. I'll change it, so until midnight of September 6, 2022. So you have plenty of time, and again, every of those plans have 15-day trial. You pay like $15-20 for a trial. Those trial payments are not refundable, but this is what you put at stake. So your bet is $15, but you probably discover a very powerful analytical and forecasting tool. Thank you very much for your time. Hope you like that video, and please leave a like for this video in YouTube. Doing that, YouTube would understand that I shared some important information with you and would suggest that video to other members. And please subscribe to my YouTube channel. Summer is over, and I plan to start posting more videos in autumn and winter. Thank you very much, and good luck with your trading.